You were told to build credit, but nobody explained what credit actually is, which is kind of insane because this one number can affect whether you get approved for an apartment, a car loan, a mortgage, a phone plan, and in many states, even how much you pay for car insurance. And here's the part that trips most people up. Your credit score does not measure how much money you have. You can make six figures and have terrible credit. You can make an average salary and have excellent credit. Because credit scores don't measure wealth. They measure how predictable you look when you borrow money. And later I'll show you why paying your card off in full every month can still hurt your score, if the timing is wrong. In this video, I'm going to explain exactly how credit scores work, what they are, what raises them, what destroys them, and why one late payment can follow you around like a financially judgmental ghost. Let's break it down. Here's all a credit score is. A credit score is a trust score, a number that tells lenders how risky it is to lend you money. That's it. That is the whole thing. It's not a measure of how much money you have. It's not a measure of how responsible you are as a person. It is purely and specifically a prediction of how likely you are to pay back borrowed money, based on your history of doing exactly that.
The score runs from 300 to 850. The higher the number, the more lenders trust you. The lower the number, the more they see you as a risk. That's not a you problem, by the way. It's a system that was never explained. Most people were handed adult financial life with no instructions, like being handed a remote with 40 buttons and told to figure it out. So let's actually explain it. Every credit score is really trying to answer two questions. Question 1. How likely is this person to pay money back? Question 2. How risky is this person compared to every other borrower? Lenders are all making bets. They're betting that if they lend you money, you'll pay it back with interest. Your credit score is the data they use to decide if that bet is worth taking. They answer those questions by looking at 5 specific things. Think of them as 5 levers. Each one pulls your score up or down by a different amount. Here they are, biggest to smallest. 1. Payment history, 35% of your score. This is the biggest lever. More than a third of your entire score comes down to one question. Do you pay your bills on time? Here's the uncomfortable part. Credit scores are weirdly unforgiving. They remember late payments longer than most people remember birthdays. One missed payment, 30, 60, 90 days late, can drop your score significantly. And that mark can stay on your credit report for up to 7 years. So if you remember nothing else from this video, pay on time. The credit system is weirdly dramatic about this. Think of it like a report card, except the only grade is whether you showed up on time, every single time. 2. Credit utilization, 30% of your score. Here's the weird part. You can pay your credit card off in full every month and still look risky on paper. That's because of utilization, which is just how much of your available credit you're actually using. If you have a credit card with a $10,000 limit and you've charged $9,000, your utilization is 90%. That looks desperate to lenders, even if you pay it off every month. Why? Because your balance gets reported to the credit bureaus at a snapshot moment, often before your payment posts. So you could be carrying a high balance on paper even when you're being financially responsible. This is why credit can feel unfair. You can be doing the right thing, but the system takes a screenshot at the wrong moment. The general rule? Keep utilization below 30%. Under 10% is even better. Imagine your boss gives you a $10,000 expense account. If you spend $9,800 of it every month, they start to wonder if you're in trouble. If you consistently spend $800, they see you as someone who's in control. 3. Length of credit history. 15% of your score. The longer your credit history, the better. This factors in the age of your oldest account, your newest account, and the average age of everything in between. Analogy. Think of it like a job reference. Someone who's been reliably paying bills for 15 years is a safer bet than someone with 6 months of history, even if both look perfect right now. 4. Credit mix. 10% of your score. Lenders like to see that you can handle different types of credit, not just credit cards, but installment loans like car loans or student loans too. It's a smaller factor, so you don't need to borrow money just to improve it. But if you naturally manage more than one type of credit over time, that can help. 5. New credit card inquiries. 10% of your score. Every time you apply for new credit, a new card, a car loan, a mortgage, the lender does what's called a hard inquiry. They pull your full credit report to evaluate you. That pull temporarily lowers your score by a small amount. Multiple hard inquiries in a short window can signal to lenders that you're scrambling for credit. The exception? If you're rate shopping for a mortgage or auto loan, most scoring models treat multiple inquiries within a 14 to 45-day window as a single inquiry, so that matters less. Important. Checking your own score is a soft inquiry. It has zero effect on your credit. More on that in the mistakes section. Here's the part most people don't fully appreciate. Your credit score doesn't just affect whether you can get a credit card. It quietly shows up across your entire financial life, and it affects what things cost. Two people can buy the exact same car from the same dealership on the same day, and one pays thousands more over the life of the loan. Not because they negotiated worse, because their credit score made the lender nervous. That gap shows up everywhere. Mortgages. A 100-point difference in your credit score can mean tens of thousands of dollars more in interest over the life of a home loan. Same house, radically different total cost. Car loans. Better score equals lower interest rate, equals lower monthly payment, every month for years. Renting an apartment. Most landlords run a credit check. A low score can get your application rejected before a human even reads it. Insurance. In many states, insurers use a credit-based insurance score to help set your auto or home insurance rates. Phone plans. Carriers often check credit before offering postpaid contracts. Some jobs. Certain employers, especially in finance, government, or security-sensitive roles, may review a version of your credit report as part of a background check. They're typically not seeing your actual score, but they can see the report. A good credit score doesn't just open doors, it lowers the price of everything behind those doors. These are the most common credit score mistakes, and some of them are things people genuinely believe are good moves. Mistake 1. Thinking your income affects your credit score. It doesn't. Not even a little. Income doesn't appear anywhere in the FICO scoring model. You can earn $300,000 a year and have a 580 score. You can earn $45,000 a year and have an 800. Credit measures borrowing behavior, not earning power. These are completely separate systems. Mistake 2. Closing old credit cards to clean things up. This feels responsible. It usually backfires. When you close an old card, you reduce your total available credit, which can push your utilization ratio up overnight. The age impact is slower. Closed accounts in good standing can stay on your report for up to 10 years, so your history doesn't vanish immediately, but the utilization hit can be immediate. If an old card has no annual fee, the smartest move is almost always to keep it open and use it occasionally. Mistake 3. Maxing out a card you plan to pay off. Many people think, as long as I pay it off every month, it doesn't matter what I charge. But as we covered, your balance is often reported to the bureaus before your payment posts. Charge $4,800 on a $5,000 card, and the snapshot hits before you pay it, you'll show 96% utilization on paper, even if you're being totally responsible. Mistake 4. Thinking checking your own score hurts it. Completely false. Checking your own score is a soft inquiry, zero effect. You can check it every single day. The only inquiries that ding your score are hard inquiries, when a lender pulls your report because you applied for credit. Mistake 5. Never checking your credit report for errors. Research has found that a significant share of Americans have errors on their credit reports. Wrong accounts, wrong balances, or even someone else's debt tied to their name. You're entitled to free weekly credit reports from all 3 bureaus at annualcreditreport.com. Most people have never looked. If there's an error hurting your score, you can dispute it, but only if you know it's there. Here's what you actually need to walk away with. Takeaway 1. A credit score measures borrowing trust, not wealth, not intelligence, not how responsible you are as a human being. It is purely a prediction of how reliably you'll repay debt. Takeaway 2. 2 things move your score more than anything else: paying on time every time and keeping your balances low relative to your limit. Those 2 habits alone make up 65% of your score. Takeaway 3. A better score doesn't just get you approved, it gets you approved at a lower cost. Over a lifetime of car loans, mortgages, and insurance, the gap between a 620 and a 760 can be worth more than $100,000. Credit is not magic. It's not a personality test. It's a system. And once you understand the system, you stop being scared of the number and start knowing how to move it. The next video covers inflation, why everything keeps getting more expensive, where that money actually goes, and why the government can't just print more of it to fix the problem. Subscribe so you don't miss it.